The European Central Bank and the Bank of England are due to announce their final policy decisions of the year later in the day, with both expected to keep benchmark rates on hold. Weakness in bank stocks contributed to a downbeat open in Europe, as the Pan-European Stoxx X index fell almost 0.2%. The financial sector caught the cold from US and Asian trading, which suffered from a less hawkish than expected tone from the Fed after it raised rates as expected on Wednesday and stuck to a projection for 3 hikes next year. Banks were the worst performing sector in Europe as cautious comments from Fed Chair Janet Yellen on persistently low inflation rattled investors. Surveys of purchasing managers' indexes from Germany and the Eurozone came in stronger than expected, but failed to boost the euro, which fell 0.1% in morning trade. In a session packed with central bank decisions, the Norwegian krone rose over 1% against both the dollar and the euro after the central bank in Oslo brought forward its forecast for when rates might rise. The Swiss franc fell against the dollar and the euro after the Swiss National Bank maintained its ultra-loose monetary policy stance and said the local currency remained highly valued. Against a basket of currencies, the dollar was largely unchanged, still nursing a 0.8% loss in the wake of the Fed's decision. The Fed projected inflation to remain shy of its goal for another year, giving policymakers little reason to accelerate the expected pace of rate increases. The makeup of the Federal Reserve is going to change a lot in the next few months, and with that we can't necessarily put too much weight behind the statement last night, said David Madden, CMC Markets analyst in London. Asian stocks rose on Thursday after the Fed decision, and the MSCI World Index, which tracks stocks in 47 countries, was up 0.1%. China's central bank also raised rates, though marginally. While Chinese shares slipped, the wider impact was limited. The key takeaway from the Fed meeting was the degree of concern shown towards low inflation, which likely led to 2 dissenting votes, said Juichi Ishikawa, senior FX strategist at IG Securities in Tokyo. The 10-year Treasury yield fell sharply on the Fed's stance and lackluster US CPI, which shows that the markets don't necessarily see the Fed hiking rates 3 times in 2018. After dropping overnight, the 10-year Treasury yield crawled up to 2.3761%. The Fed's less hawkish statements supported MSCI's broadest index of Asia-Pacific shares outside